This is Josh Jalinski, the financial quarterback. Don't touch that dial. Jon Luskin is a fee-only certified financial planner, professional, and fiduciary in sunny San Diego, California. He specializes in providing hourly advice to do-it-yourself investors. Jon is a longtime advocate of simple, low-cost investing, and his master's thesis showed how university endowments could generate more wealth and take on less risk by using passive index funds. Jon's other research has been peer-reviewed in the Financial Planning Association's Journal of Financial Planning. He's been featured on everywhere from Michael Kitz's blog, Wall Street Journal Nerd's Eye View, New York Times. So what is keeping you busy now, Jon?
So I work with do-it-yourself investors, and that's pretty much what I spend most of my time on these days. I did have a podcast previously, but I've got two young kiddos now, and so I only have so many hours in the day.
So you also serve on the John Bogle Center for Financial Literacy. Do you contribute, or are you a Boglehead? Are you online as the Boglehead community, or is that somebody else?
There's bogleheads.org, which is the forum, and boglecenter.net. That's what the John C. Bogle Center for Financial Literacy is in charge of, and that links to the forum and all sorts of resources for do-it-yourself investors. So if you want to learn about low-cost investing at no cost, check out boglecenter.org.net. We've got some great resources there.
There have been thoughts that John Bogle will be turning over in his grave with what happened to Vanguard and other institutions, kind of with the proliferation of active ETF and active investing. Are you of that opinion?
Yeah, it's certainly, it's arguably not in the spirit of Bogle's original vision, simple, low-cost investing. Certainly when I work with folks, and we talk about Vanguard's personal advisory services offering, for example, I'll let them know, hey, this can be a great low-cost option for portfolio management at a reasonable price. Just be sure to opt out of the active offerings. And I learned that recently when working with a client. We were on the call, and it's as simple as just clicking a button on their website and you opt out of the higher fee funds, and then you're only in the index offerings there. So you don't have to buy into those products if you're not interested in doing that.
Let's talk about simplicity when investing. Do you believe simplicity is crucial, and why?
Yeah, absolutely. So when you add complexity to an investing plan, you're not going to guarantee yourself better results. Now, certainly there can be more fees, there might be more taxes, there might be more trading costs, and there's certainly more work and there's more implementation. That's guaranteed. But what's not guaranteed is better results. And so for my bias, I'm always leaning towards, hey, let's make the investing piece as simple as possible. And that's especially because when I'm working with folks, I'm not going to look just at their investments. I'm going to look at their broader financial life as well. If we're still earning and working money, do we have enough term life insurance? Do we have a high quality private disability insurance policy with an own occupation definition? Have we done our estate planning? Do we have umbrella insurance? And usually I find that it's the folks who want to get really granular on their investments, really added complexity. They haven't done those much more boring but important products first. But if you're keeping your investment simple, there's not a lot to do. And that leaves you the time to do those other, I would argue, much more important products. I was working with someone recently, and he was really geeky about all the investment minutia. And he had the intermediate term, I believe it's iShares, intermediate term government treasury fund. And I want to say it had a maturity range of 7 to 10 years. And my model portfolio default has uses a different fund, Vanguard's VGIT, shorter maturity. And he was really intrigued by the difference in maturity between these two intermediate term treasury funds. And, my answer to him was, this is so much less important than go do your estate planning. I mean, that's going to make a much bigger difference in your life than, what the maturity is on your intermediate term treasury fund. So keep the investing piece simple. it's probably not going to make a big difference. It's certainly going to be more complicated, and that can even detract from your results. Or more complicated investment plan is only going to be successful if you stick with it, and it's harder to stick with it since it's more complicated. So let's keep it simple, and let's go do all those other boring, important projects instead.
And what are those important projects? Top 5, if people are listening and they're kind of clueless. You mentioned some of them: term life insurance.
Yeah, so if we're still working, or if at least we still have a while to work, you want to have the right amount of term life insurance. You want to have a high quality private disability insurance policy. Most folks are going to get a really awful disability insurance policy through their employer that really is not going to protect them in that worst case scenario, which is extended length of disability. So that means you've got to go out and you've got to go buy one yourself, just like your employer may give you a token amount of life insurance coverage as well. $50,000 is not going to do anything. You need to go out and you need to go buy yourself a private policy. So if we're still working, we're still earning money, you want to have the right amount of life insurance. You want to have a high quality disability insurance. Umbrella insurance is a big thing that's super boring, but also super important. If we're driving somewhere, we have the risk we're going to crash into someone, injure them. We could be held liable. If we own property, or even if we're renting property, if someone injures themselves, we could be held liable. So umbrella insurance raises liability limits on those existing insurance products, increasing how much protection you get. Really important if you're worth a lot. And a lot of folks that I do work with are worth several million. So they want to have a robust umbrella insurance, for example. And then estate planning, get your will. Most people need a will. Maybe there's some rare circumstances where someone may not need a will. A trust is another thing that you may or may not need, but everyone needs a financial power of attorney and some sort of advanced healthcare directive, because while you may understand what I'm saying now, in the future, given the onset of cognitive impairment, you might not be able to. And that's why those important but boring estate planning documents are critical. When you can't manage your finances, when you can't make healthcare decisions for yourself, that's where you're going to want those documents in place, so someone you can trust can manage your money for you, can make those healthcare decisions for you. So super boring, super important. Those are things that a lot of folks miss. And another thing I would say is an emergency letter. So this is also part of estate planning, but this isn't something we need an estate attorney to create. This is just an informal document you're going to create to empower, for example, your attorney-in-fact on your financial power of attorney. That financial power of attorney document says, hey, I trust you. I give you the power to manage my money. But what it doesn't do, it doesn't give them the information. So an emergency letter, just something you create. Hey, here's where all my accounts are. Here's how to access them. Here's the professionals I work with. Here's how to contact them. You want to supply that to the person you entrust in that financial power of attorney document. The legal term for that is attorney-in-fact. So emergency letter, another super boring, super important thing that most folks might miss, especially if they're trying to decide between, what maturity intermediate term bond fund to put in their portfolio.
No, this is great. So let's talk about term insurance. What is the appropriate amount to put into term insurance? What's the appropriate amount of disability? And I love, by the way, we do something with our clients called the 9 components of protection. And you've hit on many of them. There's 9 components of protection, 9 components of savings, 9 components of growth. It's like the 999 plan, like that Herman Cain guy who ran for president had. The 999 tax, we had the 999 plan. And so few people, advisors and clients, don't do the term insurance, the umbrella, and the disability in the appropriate amount. So I love hearing this. But any rules of thumb you like?
Yeah, certainly rules of thumb are a great place to start. A calculator might be better. There's lots of great DIY calculators that are out there. It's funny, I linked to one in my write-up, but I can't remember which one it is. I tend to lean conservative in a lot of these calculations and finances generally. That's my bias. It's just who I am as a person. So bear in mind, any calculator is going to assume you're going to have so much in expenses over your lifetime. Maybe you'll invest that pot of money. You're going to earn so much in returns. Inflation is going to be so much, et cetera, et cetera. It's going to assume something for taxes. So whatever number you get, be it from that calculator, if you want to buy a little bit more than that, that's probably the approach I would take if if it's within your means to afford that premium. Again, I like managing risk. I like being conservative.
Do you like a 10-year term, a 20-year term, a 15-year term?
Yeah, it'll depend upon how far out the person is from retirement and how well funded they already are. And so, maybe a 30-year term is going to be more appropriate for someone who's in their mid 20s. And if you've got someone who might have found themselves to be a higher earner later in life and they only have so many working years left, then certainly a shorter term at that point would be more appropriate.
Yeah, my general rule of thumb is this is just because people like rules of thumb, not because it's necessary. I think everybody should go through a proper financial plan with a proper, family security calculator in some of these software. We have a really good one. If anybody wants access to it, I'll give them access to it for free. But financial security calculator. But as a rule of thumb, I just take the years you plan on working times your salary. So if you're 55, you have 10 years working, you make $100,000 a year, you should have no less than $1 million in term. It's rudimentary, but it's kind of a simple rule of thumb. Disability insurance, you mentioned a high quality plan. I don't know. I've been doing this for 20 years. For some reason, when I get the disability, could be like my best friend. And they're paying $50 a month for their group plan. And I tell them they need ONOC up to age 65. And we'll get to what ONOC means. Because that's what that high quality, I'm assuming you're talking about is. But they get sticker shock on the price and they don't want to spend the money on disability insurance. I don't know if you've seen that. They'll buy the term. They'll even buy whole life, but they won't buy disability. It's like it's strange. People get they'll do the umbrella, but the disability people just chicken out on. I don't know why.
Because it's expensive, right? It costs a lot of money. We're talking several $1,000s a year for something that hopefully won't happen.
Yeah, but it's expensive for a reason. And here's the thing. I bought mine in my 20s because I heard really good speakers. And I think when I was young, I was like, I'm going to have a $250,000 a year policy. I think I paid like $200 a month for it. So if I were to ever get disabled, I get $250,000 a year tax-free for like 200 a month. And it might have been even $100 a month. I think disability insurance, everybody, when you're 25, fresh out of college, get that because it's so cheap when you do it in your 20s. When you start to be like 43, 44, it does get more expensive. But here's my pitch to people. Take 1% of your income. If you make $100,000 a year, allocate $1,000 a year to disability. If you make $200,000, allocate $2,000. It's not a perfect rule of thumb, but it tries to get them off of zero, but people don't realize I have people with Unum who had Unum through group, and no disrespect to Unum, and they're still fighting the insurance company for a disability claim. If you go cheap on disability insurance, the companies find a way to fight your claims. But then I've had people who spend the top dollar. They get the Mass Mutual, they get the Guardian, they get the Emeritus. Those companies pay quickly. They don't fight them tooth and nail for a disability claim. That's just my experience of our client base. Any other tips on that?
Yeah, so certainly, right, you want ONOC, right? There's other little fine print you want in the policy. You probably don't need me to tell you, but for those folks who are listening, right, you want that inflation benefit because $100,000 benefit today, it isn't going to be the same, 10 years from now. Partial residual disability. Those are other couple important clauses in a disability.
What does that mean for people who didn't really know what that means? Partial or residual?
Partial disability is I can work part-time, so I can earn some money, but I'm not earning the same amount of money as I did before, right? So let's use their $100,000 salary example. So maybe I'm earning $50,000 now, but I'm used to earning $100,000. So with a partial disability provision, I'll get some benefit as opposed to zero benefit because I'm not fully disabled. So that's another important part of a policy. That inflation provision, right? What we already mentioned, the benefit of that going up each year, right? Because inflation, as folks have experienced in the last few years, can be pretty real and significant on your spending power.
Yeah, but I think if you're spending, we all tell people, max out your qualified plan. Not everybody. There's all these charlatans on TikTok and strange websites telling people to not put money in their qualified plan. Which is funny because I actually like permanent insurance. I think it has massive value, but those people tend to give people who like insurance a bad name, because they're just promoting people to not put the most into their qualified plan. But the way I would say it, if you're putting 15% of your qualified plan, that's great. But if you have no money towards disability, put 14 in your qualified plan and 1% towards disability plan. Disability insurance to me is like the one thing that you need, probably more than term insurance, definitely need it more than the whole life. You need it more than 401k, because if you get disabled, you can't fund your retirement and you're still alive. So you still have bills. My dad was disabled in his 40s. It completely devastated him for life. And your church, your synagogue will give you, they'll pass the hat for about, a month. They might help you with, with some bills. So, but they will not provide for you for 30 years. And it's funny when you do hear people, and I ask, I'm sure you've had this experience with clients who have short-term disability. They're always proud, like they get to answer, yes, I have disability. And I go, what type? And they go, short-term. I go, do you have any long-term? They go, oh, no. And short-term to me is like something you don't really need if you have a good emergency fund, but you really need long-term disability. So that's great. Wonderful. So let's go into, there's a lot here, index funds, tax advantage things, and then really whatever you, I really like a lot of what you have to say. You seem like very straightforward, common sense guy. What, do you like long-term care insurance?
I'd say it depends, right? So I'll use the example of the person, right? Yeah, let's use two really extreme examples, right? So the person, I just finished their plan. And this guy, a couple, liquid investable assets, 6 million, real estate, 4 million. So, 10 million net worth. They almost certainly don't need long-term care insurance. At that amount, they have enough money where they can, almost certainly self-fund, right? Now let's go back to the guy I worked with, I don't know, maybe a couple weeks ago. This was the, earning more money later in his life. So he didn't really have a big nest egg. And so he needed, the last few years of working to really count, but he was, still older too. It was interesting because, for him, he was earning a lot, but it's not as if he was earning an infinite amount. And so it's actually struggling with the question of, what's more important for this guy, disability insurance or long-term care. Because there's an argument he needed both, but certainly when you're looking at the long-term care insurance, in isolation, he didn't have buckets of money and buckets of resources, and he was single, no kids, which even argues even more for long-term care insurance. It's not like the wife is going to take care of you or the kids are going to bail you out. He doesn't really have that sort of safety net. So, limited savings, already, on the cusp of retirement. Doesn't really have that safety net. So long-term care insurance is for him is going to be a pretty important product to help him manage risk.
As I've been, because I respect you instantly. I've never had you on the show, but because of your answer on the life insurance LTDI and umbrella. You don't know how many people I have on the show. They're supposedly personal finance experts. You know how many people? I think maybe one has ever said that. So you get instant kudos for that, because it's as easy as financial planning. If I have 30 seconds, what's the most important thing? You got to protect yourself from death, disability, and unemployment. Boom, boom, boom. Term insurance protects you from death. Disability protects you. And then you went so far. So I loved, the reason why ONOC, and I want to go there real quickly, because that kind of people, what does that mean? Means that if you cannot perform the duties of your own occupation, so if you're a hand surgeon and you get some neuropathy, so you're of a sound mind, everything's good, but you can't make 500 grand a year as a surgeon, they will pay you 2/3 of your salary, basically what you were making tax-free before is after tax. Because if you pay for disability insurance with after-tax dollars, it's a tax-free benefit. So if you can practice the phrase, welcome to Walmart, that's a bit of an exaggeration, but let's say you might have to go back to work or they won't pay you the disability claim. So that's why you don't want to go cheap on your disability insurance. And when you go cheap on insurance companies, this is the other thing. That's why there's debate in probably our circles, whole life versus term. To me, it's term first, but then, the whole might be a luxury. I always look at it as if you go cheap with an insurance company, that's why I don't like these hybrid universal life policies, because they're trying to get you the full rich benefits of a whole life, but cutting corners. When you go cheap with an insurance company, they invariably find ways to screw you. So I have Geico, I have a bunch of policies, a bunch of cars. I'm with Geico, and Geico is cheap, but it's cheap for a reason. When you go to their vendor, they give you aftermarket parts. It's not as good. But when I have Chubb and I pay a little bit more for Chubb car insurance, they pay for the top of the line guy in my town, $10,000 auto body job, beautifully done. Geico, I'm fighting. I get the repair, and Warren Buffett's great, and Berkshire Hathaway's a great stock. But Geico versus Chubb, no comparison in terms of handling the claim. And that's the same thing with these life insurance companies. There's a difference between how Mass Mutual handles the claim and how Unum handles the claim. Or, and they might be a little bit more money, but you get what you pay for with insurance. I really believe that with anything in life. And don't go cheap on the disability insurance. You can go cheap on term insurance, don't go cheap on disability. Do you find the hesitancy that I find with some people on disability insurance too?
So as someone who specializes in working with do-it-yourselfers, I'm not doing a lot of the hand-holding when it comes to the implementation of the insurance product. So I tell them, here's what you need. Here's why you need it. Here's the fine print you want in that disability insurance policy. Goodbye, good luck, go get it.
Do you find that they implement or no?
Some do, some don't, and the rest I don't know because I haven't had a follow-up engagement with them since.
Do you find, and there's always a debate in our circles. That's more of a geek discussion, Do you do hourly? Do you do percentage AUM? You're an hourly advisor, right? That's your niche.
Yep.
I just find, we're not hourly. So part of the fee is, coaching and we're meeting with them quarterly at times if they want to. It just, that the disability insurance is the one thing they hesitate on. I don't know why it is. Like you said, cost. I think it's they can think of someone they knew who had a life insurance claim or something. But disability is something not talked about because, like, for my family, it totally ravaged us. And if I wasn't a financial advisor, I wouldn't talk about it. But I think it's an embarrassing concept. My parents had to claim bankruptcy because they were disabled. Basically, they went bankrupt because they didn't have disability insurance. And for me, the minute I heard it from some, I don't know, it was like a Guardian guy who was selling disability insurance to doctors. And it just made so much sense. Like, you could take pennies to insure $1. And I think his pitch was, take 1% of your income to insure the other 99. Like, it was a very simple pitch, and I repeat it to this day. So it worked. But I actually think when I show people, right, they're just getting started. and you're running calculations and calculations on how much wealth they'll have if they save 10 to 15% of their pay. I think when they see that they can't put in as much because they pay a disability insurance, they get discouraged. And they're like, oh, I'll only have $1 million instead of $2 million. If I took the money I was going to put in the disability insurance, I could fund it. There are some great tools. I think what you got to do is use what planning software do you use? Do you use a particular one that you like?
So for tax planning, I use Holista Plan. I've started playing around with, I want to say it's Maximize My Social Security or Optimize My Social Security for Social Security planning.
MaximizeMySocialSecurity.com is a good one. Yeah. Do you do a financial planning software with your clients?
Yeah, no financial planning. It's I've got some of my own spreadsheets, but then they also get a very long write up. Just lots of details and instructions that do-it-yourselfers needs.
I've interviewed people for like 20 years, and very few people have said the boom, boom, boom. So I really commend you for that. Nobody did that to my parents. Nobody said, hey, get disability insurance. When my father went on disability, he had to cash out his Vanguard mutual funds and his cash value life insurance to go on Medicaid because they were so poor due to medical expenses. That's another thing as I've evolved, like Medicaid trusts and trust planning. I was more of like a boglehead, like with attorneys, like be cheap on the legal work. After seeing a lot of people ravaged due to that type of stuff, I'm more into trust than I was when I started. How about you? Do you like trusts, or you think they're a waste of money?
Yeah, so I'd say revocable living trust is going to make sense for a lot of family situations. I'm certainly going to defer to an estate attorney here. This isn't my area of expertise, but certainly for my family, we have a revocable living trust. If you've got minor children, it almost certainly makes sense. Again, I'll defer to an estate attorney. If you're looking to avoid probate in your state, it could almost certainly make sense that very simple revocable living trust can be applicable to a lot of folks. As they get more complicated with the trust, irrevocable trust, that's really out of my wheelhouse. I tell folks to speak with your attorney, your state attorney about that. Certainly for physicians, there can be value in things like a domestic asset protection trust, but again, that's really for liability concerns, given all the risk they have in their practice. But that really is out of my wheelhouse. Again, I'll tell them to something they should think about speaking with their attorney about, or if they're pretty far over that lifetime exemption amount, they probably want to consider some strategies as well, irrevocable trust, et cetera, to help manage or avoid that estate tax bill.
And I also think here's a risk you should go through with clients that I've been seeing, because I started about 20 years ago. And I used to be of the opinion, get a will, living will, power of attorney, healthcare directives, beneficiary designations, revocable living trust. You don't need to spend a ton of money on legal work. The more I'm in this and the more I'm handling people who've inherited money from their parents, I think the kids are a big risk to the plan. Here's what I mean. You have greatest generation or older baby boomers who saved and scrimped, and they came from making 50 grand a year, 30 grand a year. Now they have $2 million saved or something like that. They pass, leave the couple $1 million to their kids. The kids piss it away in a year or less. And they're not that they're irresponsible, but it might be they pay off a house. It might be they're going through divorce. It might be they want to go on vacation. It's just, I'm seeing the assets liquidate. So I think one of the things I'm coming up with is a thing called Unbreakable Legacy, where we're partnering with attorneys of clients, not like an official partnership, but just meeting with their attorneys and saying, what about this? What about this? What about this? And I'm seeing the spendthrift. Even if you have a responsible kid, they still don't treat the money like it's theirs. It's like a blank check. Hey, we're going to go buy that. So I'm a bigger believer in trust than I was, 10 years ago, and certainly than it was when I started. What are some other boring topics? I don't view this as boring, but some people might view life insurance, disability insurance, umbrella, estate planning is boring. Any other boring topics that are often neglected but should be prioritized by our listeners?
Yeah, no, I say that'll be life, disability, estate planning docs, umbrella, and then that emergency letter. And it's funny because usually it's those topics that I always put on page one of my write-ups. Do these things first, before you get into, intermediate term treasury bond, marginal difference in maturity.
Yeah, do not pass go, do not collect $200. And so then let's talk about, we talked about the boring topics. Let's talk about, you're a big fan of index funds. Any special approach that you adopt? Any, the margarita portfolio, the Merriman portfolio, any particular one that you like better than another?
I love this question because I actually have to give a presentation at this year's Bowlegs conference later this year just on this topic. And in the presentation, I'm going to argue for the exclusive use of single fund solutions. So that's going to be either target date funds or balanced fund. And so these funds, they're ultra low cost. They're index funds. They're diversified. They're globally diversified. We've got practically every investable stock in these funds. And then the most important part is that they're set it and forget it, right? You have that target date fund. There's zero maintenance you have to do. You have that balanced fund like the Vanguard life strategy funds or the iShares allocation ETFs. You've got that, 60-40 mix, as a retiree, and then you're going to hold that thing forever. And then you need money, you sell some shares, and that's it. And it's that simple investing approach that I'm a huge fan of, because again, we can add complexity. We can even make, a relatively simple 3-fund portfolio, total US, total international, high quality bond fund, which is a pretty common bull hedge approach. But that's going to require annual rebalancing. And while you might be super excited and, can't wait to dig into your, spreadsheet once you go to do your rebalancing now, you might not feel that way 10 years from now. And you might not have the cognitive ability to do that 20 years from now. And so that's why I really love these single fund solutions. Younger folks, target date funds, but if you're on the cusp of retirement, you're already in it, just that single balance funds that already has everything in there for you. Because again, all the points we already mentioned, and then also a lot of these folks haven't even done their, important but boring topics either. So yeah, let's keep it simple, right? I really, really love these single funds. I use them personally, and it's always going to be my default when speaking about an investment solution for someone, right? If they don't have any preference for how to invest, I'm like, great, let's start with the absolute simplest solution possible. Now, again, we're do-it-yourselfers. A lot of folks like to tinker. So, they want to have the 3-fund portfolio. Great. Talk about how to best manage a 3-fund portfolio. They want to add a factor fund to that. Great. We'll talk about how to do that, pros and cons of that too. But if they're not coming to me with a preference of how to invest, I'm going to open with the simplest investing solution possible.
Do you prefer the target date funds or like just a balanced fund?
So it depends on where they are at their stage in life. So younger folks, it's going to be a target date fund. But if we're in retirement or at least close to it, then having that fixed static portfolio at that time is going to make sense.
Have you looked in? I have this one friend who written an expose on target date funds, and I always get a little I don't really want to spend that much time on that issue, to be honest. But since you're an expert in this, he hates target date funds, and he claims Barry Dyke. I don't even know who he is, and Barry Dyke is brilliant, so I'm sure he's right. But like he can pinpoint to, okay, Vanguard allocated 1% to SoftBank, which gave money to the guy who I want to be clear here. I'm not saying they did this because I didn't, but I generally trust that Barry knows what he's talking about when it comes to this. Is like his niche. And the 1%, basically they're packaging deals, and he's uncovered this, and people haven't, like you look at Fidelity Contra Fund or some of these Vanguard funds, and this is where, Bogle's spinning in his grave, God rest his soul. They're now packaging private equity deals within these veritable funds that had generally a passive outlook for years, because they're allowed to put a certain percentage without it altering the nature of the fund. So like he's gone, and I said, Barry, you got to prove this to me. And he would literally show me, okay, this money went to WeWork, for example, as an example. Did you get that granular into that or not really?
Yeah, no, I can't say I can speak to that. But I would imagine that issue, if it did exist, wouldn't be just an issue with target date funds. It'll be of any broad-based index fund.
No, he's claiming there are index funds that are purely index funds, where within their charter they can't do that, and then there are other funds where now I'm using Contra funds, which has had a great track record over the years, so I'm not besmirching that fund, but like they reserve deal flow. So like, Contra Fund might have 1% in SpaceX, or Fidelity Blue Chip Growth might have 1% in SpaceX. And I like those funds. I mean, those are good long-term funds. And then they're actually putting it in some of the targets. So he has some rankings where he ranks some target funds better than others. I didn't, but like if you buy, let's say, Vanguard S&P 500 index fund, it's buying the 500 stocks. If you buy Vanguard VBR, it's buying the small cap value index. If you buy, so he would more like those than a target date, because a target might embed it. But I guess your point is it doesn't really matter. It's a small percentage. So, I mean, to me, it's like, Barry, I get it. You're right. But I think it's a good thing to let people know, but it probably isn't a thing if somebody's has 20 options in a fund and they like the Vanguard, 2030 fund. I'd rather them be in that than not invest or put it all in cash or something like that.
Yeah, I will say that my love of target date funds is going to be within the sphere of index fund investing. So it's only going to be ultra low cost index target date funds. So Vanguard target date funds, the Fidelity index variety of their target date funds, because they have two lines of target date funds. They have active and they have index. Same thing for Schwab. So if you're buying your target date funds from Schwab or Fidelity, not investment advice, but you want to consider if they have index fund in the name. If not, you're going to be paying a lot more than you could be otherwise.
And they're pushing those more and more. I don't know do you use custodians or no?
No, yeah, no custodians. I don't manage money. I just talk to people, and
they're pushing that more and more now as their fees have compressed. Their active solutions, some are good, but you just got to realize you might be paying extra that you're not. I don't mind an active, like if you have a bond trader who really knows what they're doing or something like that. But, what about people, the one knock on all this, the 60-40 portfolio or a balanced approach or a target date that I could see, other than Barry's point, is that if you look at 2022, where the bond market imploded and some of these target date funds lost 20%, and they weren't supposed to lose that much because the bonds got destroyed. What would your take on that be? What's your counter to that?
Yeah, I can't speak to any particular fund losing 20%. I'd have to look at the data, but insofar as a target date fund lost X, if my benchmark is a 3-fund portfolio, well, then your 3-fund portfolio would have lost the same amount. My argument is simply, hey, we don't need to make a fund. We don't have to buy all these funds. Let's just buy this one, and it's going to do everything for us automatically. Insofar as bonds losing value, I mean, that's a normal part of the investing process. If you're invested appropriately, if you have the right amount of risk, if you have the right moderate spending plan, then all those investment gyrations, it doesn't really matter. If we've got a target date fund and we're years away from retirement, then if it lost 20%, it doesn't apply to our particular circumstances, because it's going to be maybe for me, I've got like 25 years until my target date fund matures. So if it lost 20% 2 years ago, I don't care. Now, if I'm a retiree and I've got my 60-40, single fund and it loses 20%, then the way that risk is managed is by having a sustainable spending plan. If you're spending a moderate amount from your portfolio every year, it's going to be less impactful if your fund is down 20%, because you're not spending 100% of it that year. You're going to spend, maybe 4%, maybe more, maybe less, depending on your circumstances. Or if you even have flexibility with your spending, maybe you can spend a little bit less that year, spending a little bit less when the market is down. That can be a great way to manage the risk to a retirement plan, but certainly not, making any changes. Certainly not panic selling. Certainly not paying more to invest. That's not going to be the solution in that circumstance. Keeping your costs low, taking the right amount of risk, sticking with your investment plan, having the right spending plan. That's how folks can successfully best manage risk in or planning for retirement.
What about tax mitigation in retirement planning, financial planning? What do you use with clients to help them with that? You mentioned something about a tax software.
Yeah, so I use Holistiplan. Helps me look at a client's situation quickly and easily. And then if we're going to do some year-end number crunching, if we want to figure out how much to do in Roth conversions with sort of tax-efficient spending strategy, we want to do, stay clear of the IRMA breakpoints, for example, then I'll use Holistiplan, mid-November-ish to do that sort of number crunching for folks.
No, wonderful. Anything you want to share to our listeners that you haven't been able to share? Something I didn't ask you that you're passionate about?
Yeah, I'd say, lately just this increasing just obsession with keeping that investment piece as simple as possible. Like I mentioned, this is going to be my first chance doing a presentation on single fund solutions at the Bookheads Conference. They've had me do other stuff in the past, but this is my chance to get up there in my soapbox and talk about folks. Again, you can add complexity to a plan, but it does not guarantee better results. It certainly does make your job harder. There was a do-it-yourselfer that I work with, and I can't ever forget this story. It lives rent-free in my head, as the cool kids like to say. Gentleman, he had an AUM portfolio manager, learned about low-cost investing, fired the manager, and then decided to create his own 10-fund portfolio. So he created his 10-fund portfolio, and then 1 year later, when it was time to rebalance, he worked with me for the first time. So I didn't coach him through the unwinding the positions of his existing legacy advisor managed portfolio, which I do often for folks, but I didn't for this guy. But he came to me with his 10 funds, and he said to me, and I just can't forget this, I regret making it so complicated. And I've never have anyone say the opposite, right? I've never had anyone say, oh, I regret making it so simple. I regret making it, so easy to manage for myself. So again, if we're adding complexity to the investment plan, really need to take a long, hard thought about why. Why are we doing this? Are we really going to benefit? And I would hope that if folks, do think about that and think about the unknowns that come with adding investment complexity, that they'll opt for the simpler option, and then hopefully their future self will thank them.
Great. Well, thank you so much, Jon Luskin. Follow him on Twitter at Jon, JonLuskin. Any books or websites you'd like to plug?
So I'm at JonLuskin.com. I've done a bunch of podcast episodes for the Bookheads Live. So folks can check out those past episodes. We have some really cool guests on that. I've also done some interim hosting for the Bookheads on Investing show. Rick Ferry, the normal host of that, got to interview Bill Sharp. So that was incredible. So folks can check that out if they want to, nerd out on what a Nobel Prize winning economist has to say about investing, which is do what Jack does, right? Jack Bogle. So that was pretty cool to hear, Bill Sharp say that. And again, boglecenter.net, great resource for do-it-yourself investors. We can learn for free how to invest simply and easily for yourself.
Great. Thank you so much for joining us. Jon Luskin, everybody follow him. Thanks so much for joining us.